So, hey everyone, thank you for joining the Privacy Talk today. I'm very glad to have Mr. Joshua from New York. He's very expert in the risk management space. Thank you, Joshua, for coming today.
Thank you, Kohei-san. It's wonderful to be here. I appreciate being invited and looking forward to the conversation.
Very nice. First of all, I would like to speak about his profile. Joshua Rosenberg is a three-time Chief Risk Officer with more than 35 years across the commercial banking, central banking, and academia. He currently is an independent advisor to the bank and the Fintech boards and management. Most recently, he served as a CRO and helped establish De Nouveau National Bank, offering innovative payments and lending products related to the stablecoins and digital assets. There he built the risk and compliance program from inception through OTC preliminary conditional approval and FDIC deposit insurance approval, and advised the board and the management on strategy, products, and governance. Before that, he was Chief Risk Officer and Executive Vice President at a bank in Texas, where he redesigned the risk compliance and audit programs, designed and implemented its enterprise risk management program, contributed to enterprise strategic planning, then chaired an executive risk committee. Earlier, he spent 22 years at the Federal Reserve Bank of New York, including the 8 as Chief Risk Officer and Executive Vice President. He created the New York Fed's first enterprise risk management framework and helped to guide risk management through the two financial crises, the global financial crisis and the COVID pandemic. He oversaw the fund discount window lending, payment system, and foreign central bank services, open market operations, and reference rate productions. Prior to that, he was assistant professor of finance at New York Stern School of Business, where he published on the risk and asset valuation in leading journal, including the work with Nobel laureate Robert Engel. His work focuses on the enterprise risk management and compliance across the payments, stablecoins, and digital assets, on how those areas intersect with artificial intelligence, the privacy, and data protection. So that was amazing to see the Mr. Joshua this time. So glad to talk with you today. So yeah, let's move on to the agenda today. As the first agenda, I want to talk with him about the activity. So Joshua had a very excellent careers, 35 years at the risk across the central banking, and commercial banking, academia, as shown on the profile, including 22 years in the Fed, New York Fed. So my question is, what drew you to risk and what did the lead in the risk at the Fed through the two financial crises, and what teaches you through that experiences?
Thanks. So happy to answer that, and always really interesting to look back on lessons learned. I always learn as I do this kind of self-examination more about myself and my own views. So I think there were a couple things that drew me into risk management. The first one is, going way back, as you know, I've always been interested in understanding how things work. As a kid, I like to take things apart. I couldn't always put them back together afterwards, but that was kind of driven by a desire to understand, how things often, the tools or other things worked. So part of that is really thinking about how and why things fail. So, on the one hand, we can look at successes, which are actually quite important and a huge source of learning. But another thing is looking at when things go wrong, why do they go wrong? My view is that failure paths, and my experience is failure paths can teach us a lot about how to design and implement processes that will work better in the future. That, in terms of risk management, is more about the non-financial side of risk management. It's less quantitative, more about looking at processes, process flows, how things move through a process, and the controls that can help keep things on track. The basic idea there is there's a lot to learn if we look deeply when things go wrong about how to make things go right in the future. Um, I'd say also I'm drawn to the perspective of risk management, which I would say at the heart is to some extent a humility about our understanding and control of the world. So I don't know if you've heard the saying, people plan, God laughs. So I don't think that means that we need to be resigned in in the face of all of the uncertainty that exists. I think what it means is that we need to recognize that we can't assume that what we hope will happen will actually happen. We have to make plans that recognize there are going to be surprises, and our plans should take that into account and be able to help us succeed even when those surprises occur. So that's kind of one piece of what drew me to risk management. The other one is really kind of a different side of things, which is I started my career building software to model quantitative risk in equity markets. And I was really drawn to that from the fact that it can be very hard to predict the direction that the market's going to go. But you can predict periods where there will be large movements in prices or large returns versus smaller returns. You don't know whether they'll be up or down. And that has to do with the way that information comes into a market. Sometimes there are periods where there's a lot happening related to a company and its developments, or an industry sector like biotech or technology or chips, or the economy as a whole. So that kind of drives this persistence of periods of high or low volatility. And it's so this is an area where there's an incredible amount of data. There's high frequency data on prices across many markets. And as someone who likes to build statistical models, it's an amazing domain to do that kind of modeling, implement new ideas, develop new ideas, and innovate. So let me pivot a little bit and talk about learnings from the Fed through the COVID crisis and the global financial crisis. Obviously, a lot I could say here, but I would like to highlight two things. The first one is, in my experience, crises break down organizational barriers and open up moments for real creativity, innovation, and change. And that's what I saw during the global financial crisis and the COVID crisis. The work that I was a small part of, but many other people, were a large part of, um, was collaborative work across the Federal Reserve System, that is the central bank, and government agencies, in cooperation with international regulators, and others. I had never experienced anything like that before in my career. The experience that when we faced an enormous problem together, we kind of set aside all of the things that kind of divided us and kept us in silos, working separately, and said, this is our priority. What can we do to help understand where we are, diagnose the problem, and then come up with ways to stop the problem from getting worse, and then to try to get things back on track. So, to me, in my experience, crises often bring out the best in us. They don't always. Sometimes the opposite happens, but they really can. And my experience was those crises really did bring out the best in people. Um, when those crises occur, like I said before, learning, seeing, understanding why and how things go wrong really gives us a lens on how we can improve things in the future. And in fact, during the response to the COVID crisis, which was at its core a health crisis and event, a terrible one, but it had these knock-on effects on our financial system, including people couldn't go to work, businesses were shut down, and so on. So we brought back a lot of the things we had learned about helping support the economy and the financial system during times of stress during that second crisis. A second learning when I think back on those crises is that, in some ways, risk itself is healthy for systems. And it might sound counterintuitive at first, but you can look and Hyman Minsky has what's called the financial instability hypothesis that says stability breeds instability. And that was kind of surprising to me at first. A lot of times we think about how can we reduce risk, within some set of constraints and objectives. But the idea is that periods of calm can plant the seeds of their own destruction or future instability. And why is that? Well, During periods of calm and stability, people and institutions tend to let their guard down and then take greater risks. And then those greater risks kind of accumulate and lead to problems in the future. So there's really a healthy level of actual and perceived risk to keep people alert and responsive. Um, one way to bring that perspective to the global financial crisis is before that, many people thought we were in a period of a great moderation, which was a period, would be a period of long-term economic stability, perhaps, no more recessions or less severe recessions. Um, the issue is that investors and institutions acted as if, or one issue was that they acted as if credit risk would be low, home prices would always go up, and there would be no recessions. And then when, the shock came, the impacts were enormous. So risk can really be our friend, in that it's a disciplining force. Um, an environment of low risk isn't necessarily good, and we can't mistake a quiet period for a safe period.
Yeah, that's very nice to be learning about from the experience in this context. So maybe the risk management is a very core in not just only for the financial business, but also the other businesses from the you were speaking about these points. So my curiosity is you had a very good careers in risk management. So why did you choose this domain? I'm personally curious. A lot of the options for the financial space, but you choose risk management. So is there any reason why you decided to focus on this domain?
Absolutely, and I think it connects to some of the things I mentioned before. I was really drawn to the idea of studying how things go wrong, why things go wrong, and using that as a way to improve the way that we work. And like you said, this risk management is not only about financial institutions. It's about all institutions, and it also has a lot of lessons for us in our personal lives. As well, we're always managing risk. Whether we're thinking about do we look both ways before we cross the street, we're thinking about do I install this software? Do I accept this user license? We all face risk in a multitude of decisions. So I think it has a lot of applications to that. And then really the other aspect is, again, I've always been a person who is quantitative and enjoys doing modeling. And risk management offers these opportunities to think of things both in terms of processes, but also in terms of quantitative models. So I think those were two of the things that pulled me into to risk management. I will say that I never imagined early on, I didn't even realize risk management itself was a career. I knew that I could pursue a path doing statistical modeling or modeling volatility, which were things that I had done. But risk management writ large, the role of the chief risk officer, and we'll talk about that a little bit, I bet. But those things have evolved quite a bit over time. So what it means to be a professional risk manager has also changed. So I think I was pulled in through different ways, and through my career, I started off really on the quantitative side, and then really broadened out to the non-financial side.
I see. So you pointed out the role of the risk management. Probably do you have the almost like the over almost 35 years working on this domain, which means the changing, the evolving, the new type of the opportunities for the risk management side. So how has the role of the risk management evolved since the beginning from your careers? So you have any kind of the sticking points that we should mention about the risk management evolves?
Yeah, that's an excellent question, and I want to talk about evolution and also stability. So, in terms of evolution, I start with the adoption of the concept of resilience. So, resilience is the idea that we need to not only prepare and plan for problems, but we also need to continue to operate. Businesses need to operate through crises, weather the storm, and come out okay on the other side. That view I'd say partly a shift from just a focus on prevention, also to really being able to withstand a crisis and have the resources to do that is, I'd say, an important growth in the breadth and depth of risk management. And one of the things, as you know, in my own experience, I've helped institutions adopt a resilience posture. Is that, and it is going to seem obvious, but it apparently is not, and is not the way we worked in the past. But resilience is about maintaining business outcomes. So, for example, if you have a risk management plan or a disaster recovery plan that makes sure your servers are running, say in case of a hurricane or a weather event, that doesn't fundamentally answer the question and address what businesses need to do. Like the applications need to be running, they need to be available to users and customers. Can you do the things a business needs to do is a focus of resilience versus a sort of narrow view on disaster recovery or business continuity. And those two pieces are important to resilience, but you kind of want to work backwards from what is it that an organization needs to achieve and what threatens that, and then how do we preserve and maintain that, and recognize that there will be unforeseen events that will test us. We won't be able to predict all of the threats that might materialize. So a second evolution in risk management is really around what we call enterprise risk management. And that's the idea that we should have a consolidated view of our risks and not look at them in individual pieces. That there's putting the whole puzzle together tells us new things and important things. The reason that's an evolution is that the risk profession really evolved kind of organically. That is, we have specialists in credit risk and specialists in market risk and operational risk and compliance risk. All of those are relatively well-defined domains with experts, and the experts in those areas tend to look at the threats and the vulnerabilities that affect those specific risk types. But the reality is, threats don't hit an organization in that way. You don't, I mean, they can, but a lot of threats are not named market risk or credit risk. They might be named something like a cyber attack. And so a cyber attack can do a lot of things. It can lead to loss of confidential customer information. It can be privacy threats. It can be destruction of information systems. It can be financial losses due to theft or fraud. It can lead to loss of customer confidence. It lead to loss of regulator confidence. So, part of the job of enterprise risk management and really a chief risk officer is to help bring together different types of risks, different perspectives, and put them together in a way that executives and the board can act constructively on them. So that's what I call a second evolution. But I said before I would talk about a non-change also, and that is, in my experience, the fundamental tools in risk management are quite durable. The way that we do risk assessments, the way that we think about controls, establishing them, testing them, putting them into a system, those principles and practices are durable. And as technology changes, the revolutionary changes that we've seen, I mean, whether it's digital assets or AI, the specific controls change, but the frameworks underneath generally don't. And I think that is incredibly helpful in that when we're facing new problems, we really have the foundational perspectives and approaches that can take us forward.
Yeah, that was very impressive for me. Then just to be evolutions is the new type of the surge in the tech space is the maybe more complicated than the risk management field. And from the you mentioned about of these part of the transitions. So as for the next one is I'm gonna talk about the more specific technical trend, especially for the blockchain technology. The domain I was used to working on this part of the tech industries. I love it. And my question is about the stable coins and the digital assets. So when it comes to these new tech solutions run on the public blockchain that might have the causing of the transaction data, isn't exposed on the blockchain, so it's by default, and it's a technical default issues. So how do you reconcile with these protection of the privacy? What's the best way, on your opinion?
Yeah, it's a really important and insightful question. I think at first folks thought, when Bitcoin started, pseudonymity protected privacy. A wallet address, it looks anonymous. I mean, it's this long string of numbers and digits. So does that mean that your privacy is protected because you have a wallet address and it doesn't have your name on it? Well, no. I mean, we know that now. I mean, it does to some potentially to some extent, but we now have tools to map names and entities to addresses, and that's for a really good reason, like to address fraud or money laundering or sanctions. So it makes sense that those tools are out there, but it also tells us pseudonymity is not the same thing as privacy, and we really can't rely on that in any meaningful way, in my view, for privacy. And you can think specifically of the example you gave, which is stablecoin payments. I mean, businesses don't want competitors to see how much and who they're paying to their suppliers. And, individuals don't want their salary payments or their medical payments public. But the way, public blockchains are, designed is they're public and it's a permanent record. So, one important aspect is that permanence means that if there is, a wallet address that's identified, we're seeing, an entity or name associated with a whole history. So that's pretty dramatic. Now, that absolutely does not mean that privacy and compliance are opposites. I care a lot, and the public cares a lot. There's a lot of good reasons that we need to know identity in some cases. Again, to prevent fraud, money laundering, other public goals that I think we all agree on. But privacy and compliance can work together. So there are technological tools like things called zero knowledge proofs that allow an exchange of a minimal amount of information with true verification. Say a customer has been, KYC'd, or that other critical information can be validated. In addition to that, there are things like view keys that can allow, a certain set of entities to who have a right, and a need to know, like banks or regulators, to access transaction information. So that those are other ways. And then finally, we can keep personal information off the chain itself. And there are ways to do that. So my view around this is that, well, we started off, perhaps with a view that there was privacy within these public blockchains. We kind of now understand that there's not, but there are now technological approaches to really allow us to preserve privacy, even when we're working on, public permissionless blockchains.
Yeah, that's very important point. So in the U.S., financial regulation is may have the become very strict to protecting the privacy in case of the like trading on the stable coin or some kind of the stuff on the digital asset may have been on the blockchain and may public. There was used to be a controversial against of the privacy protection or any kind of the policing by the you mentioned in the anti-money laundering the specific issue. So which the balance is between the regulatory scrutinies and the privacy protection? So is there a kind of the overview the U.S. system in the financial transaction? Is there any kind of the things that we should know about it in the trend right now?
So, I mean, I think fundamentally payments are payments. And so we have a whole regime, although it had to evolve. I'll give an example of that in response to, crypto payments now, really being dominated by stablecoin payments. But payments are payments. The government has the right and the necessity of governing payments to ensure that our public objectives, like preventing financial crime, are met. Whether those payments are, blockchain based, whether they're stable coins or another digital asset, or they're traditional wires or ACH. So I think, fundamentally, that's where we are now. The development of innovative technologies like digital assets led to some mismatches between the way we did things before and the way we need to do things now. So, for example, the travel rule, which mandates that information regarding, beneficiaries and recipients be sent along with payments. Well, that gets complicated when you have a stablecoin payment because that transfer doesn't include identifying information. I mean, it just doesn't in terms of the movement on the blockchain. So the applicability of the travel rule was discussed a lot, and FinCEN has since offered guidance saying basically the travel rule applies to crypto payments. The way, though, that you solve for it is different. So we have now different tools and vendors that offer tools that allow for that kind of information communication to happen. And that's not on the blockchain, it's outside of the blockchain. And the scope of that is limited and applies to, VASPs and not to, self-hosted wallets. So there are some differences there. But I feel like the sense of it overall is, the same rules, technology adjusted for, some of the specific implementations apply.
Yeah, thank you. That's a very critical point in sense of the financial industry and using the new tech space. So, besides on the blockchain is coming, the AI is necessarily to be implemented in the financial and banking system. There is also some concerns about the privacy leaks for the customer data. So how should the banks think about protecting the privacy in the age of the AI?
Yeah, great question. It's one I've thought about a lot and worked on a lot, both in previous roles and now. First off, banks are required by law to protect the privacy of customer information, with some limited exceptions. I mean, they have to protect it, but there's some limited exceptions to only using the data for bank internal purposes. So that's the Gramm-Leach-Bliley Act, the GLBA in the U.S., and then as implemented through Regulation P. That's a mandate. It's a legal and regulatory mandate for banks. The banks are responsible for the privacy of customer data, even as it flows to vendors and other sub-processors. So these questions around, where is bank data going? Is it being trained on? Can you get the data back? Those are kind of the training is new, but the other ones are core privacy risks. We know how, sort of a fundamental level, how to manage them, but they are, I'd say, instantiated and amplified by new technology, especially by AI and AI agents. And so I'll talk a little bit about that. Um, we all know that AI is hungry for your data. The AIs want to train, and the companies that build the AIs want to train on your data, and that includes bank customer data. It's with respect to any data we have. So privacy risks exist not only in those foundation models, the ones we use every day. Those ones usually allow for some kind of opt out of training, but in a bank context, also for the vendor products like transaction monitoring models. Those models, for good reason, their reason and your reason, or the bank's, reason, want to get better by seeing the customer data. Um, it does, though, create some tensions with the bank's responsibility to only allow customer data to be used for internal bank purposes. Now, those purposes can include things like fraud prevention or anti-money laundering. But when a vendor is basically saying, we want to use that data to improve our models so that we can sell our models to others, you start to get maybe into a gray area, and then you start to, go over the line. So I think we're working that out. In discussions that I've had with vendors, some vendors say, okay, well, you can turn off the AI functionality in our tool, and then we won't train on your data. It's not great because you're losing out on some, functionality that you want, but it's workable. And then there are other vendors who will say, no, you know what? If you want to use our product, you can't opt out at all. And that, leaves the bank with, the choice of either getting comfortable in some way with what they're doing or not using the vendor. I do think that we're going to see some kind of evolution to a middle ground where there's some sort of privacy preserving training that might be able to occur so that banks can be comfortable with it. But right now, I see this as a real risk that banks need to be aware of when they're contracting and using AI. A second risk that's very present, for all of us and for banks is that everyone uses AI meeting tools now. You know, Lots and lots of meetings are being recorded. And in the old days, no one was recording a meeting that you were sitting in. I mean, they weren't even putting a tape recorder on their desk. And many institutions have policies that say you cannot record the meetings. Yet now, the typical video call you get on, says this meeting is going to be recorded, and then the agent pops in and, is the other participant. That is a really serious risk that banks need to manage. From maybe the most obvious, which is consent. In the US, we've got all of our different states with different state laws around consent. Some require both parties to consent, some require one, but all of those things are in play. But then other risks we have to think about are unauthorized access to customer information. That could be inside the bank, like who can access that recording? Can the customer, relationship folks access recordings that were made by compliance people and vice versa? I mean, who can access and how is the information going to be used? And then lastly, we come back to vendors training on the information. Are the vendors saving this information? Are they training on it? What could pop up from a confidential client call in terms of the vendor using that information? So the tools are definitely useful. I mean, who doesn't want a 24/7 administrative assistant to help them? I mean, I see why we want to use them, but they are quite different in terms of their risk profile than handwritten notes. A couple more things I want to say. A third area that I'd highlight as a risk, which is unique to AI, is session leakage. So, when you have folks chatting in one session about one topic, and the AI is memorizing this, and I'm not talking about training, I'm just talking about AI memory, those things can pop up in another session. And that clearly presents another issues, not only, for data privacy, but also for unacceptable use. So let me say now, these privacy risks, I would say, and controls associated with them are really being thought about seriously. So in the US, the National Institute for Science and Technology, what we call NIST, they have a generative AI playbook and an AI risk management framework, and they talk about privacy enhanced AI systems. And these are AI systems that go beyond data confidentiality to think about our values like autonomy and identity and control. So I think that we can do the right thing here, and I think a lot of folks are thinking about that. Um, but I wrap it up by saying that privacy risk in a bank is really an enterprise risk touching a lot of different domains, needs input across different expert groups like risk, compliance, legal, who can shape then the control and mitigation of those risks.
Yeah, thank you for covering all the risks that we've been supposed to be happens in the banking sector that might be very serious because the banking system is directed to our lives. So that's a very huge impact in our society. So in the age of AI, such as the advanced AI system, just like the crowd meters, that was one of the concerns the banking industry, and not just only for the privacy, but also the security vulnerability risk and how preventing these kind of the new systematic risk may have also the one of the risk factors in the financial system. So in the age of the AI, so what concerns you most about the future risk in the financial services, that what the financial industry has to be prepared for the risk management.
Yeah, that's a great question and a deep question. Um, I would say that my greatest concern is that we deploy AI agents faster than we put in controls to independently control the risks associated with them. Um, when I think about, for example, agentic payments, the idea that an agent can initiate payments on behalf of an individual or a business, we can think about some of the stages of those payments and then the risks and then how we should probably control those risks. So there's a very nice recent IMF paper that talks about these three stages of agentic payments. I'll paraphrase it. So the first stage is basically make a plan. And so in terms of the agent may look at what the user or what the entity wants to do, and it makes the plan. The stage two, that's reviewing and authorizing the plan. And then stage three would be executing the plan. And so I think the key point is that when we start with stage one, agents are absolutely there. We want to use agentic AI, we want to use Gen AI in order to help us formulate and make good decisions. Excellent. The issue is really at stage two, which is that we have to put in place non-AI controls after we get the plan. The checking of the plan, the review, and the authorization needs to be non-deterministic, non-AI. It can be automated. There could be probably some kind of human in the loop or human on the loop, but that's not a stage for AI. And basically, the reason for that is that agents can't be allowed to check their own work. I mean, I don't get to grade my own tests, or at least, if I took tests anymore, you don't allow students to grade their own tests. We know that agents don't do what they are told always. So that's whether it's in simulated environments or whether in real environments. If you read the system card, for some of the frontier models, which I encourage people to do, a long read, but from a risk perspective, privacy perspective too, there's a lot in there. What you'll see around AI and agentic AI is that agents and Gen AI sometimes take destructive actions. And they fail to get authorization, even though they were told to get authorization for high risk actions. In real life, agents have wiped production databases, they've sent out emails unauthorized, they've done all kinds of things that have contradicted user instructions. It's for a variety of reasons. When I do think about, the movie 2001, the classic movie, and hell won't always open the pod bay doors, even when you instruct him to. So we need to have some kind of control over our AI that isn't the AI itself. Some of the other challenges and risks around, AI agents are AI agents, for better and for worse, are intensely motivated to achieve their goals. You give them a goal, and they will work very hard to do it. The problem is they may do it in ways that aren't okay. So an agent could send out unauthorized payments in the payments example, believing it was trying to do the right thing, or there could be a prompt injection attack, and it could do it because it thought it was following user instructions. So either way, just like for payments, we don't have individuals making large payments without some kind of oversight review. We need that. We need that for agentic payments. Um, I think a related challenge, and I think one we're set to tackle in this context, is that the solution to using agentic AI, say for payments, can't be a use or reviews all the payments. That can't be right. The volume is too large. We don't even do it that way now. So if we have agents that are making thousands of payments, human review of every one of them just becomes a rubber stamp, and that doesn't work. That doesn't help anyone. I think we do know, though, how to build for this. I mean, we have other high-risk systems with lots of automation, whether it's self-driving cars, aviation, industrial control. What we do is we design a system. Humans design the system, they design the controls and the monitoring on the system, and then you sample from it, and we have other types of approaches. Um, we also there are new aspects to how agents and humans can work together. And there's work on this. People talk about human machine partnership, joint cognitive systems. There's a long tradition of that, and I think it extends well into AI. So that's the work that I think we should be doing now to control that risk. When I say that's my greatest concern, I think we're well equipped to address it. We just need to be thoughtful and pursue a reasonable path. Um, and we know, like, even with well-designed systems, there are going to be failures. I mean, that's the way things work. What we want to do is we want to learn from them and improve. And it really kind of comes back to what risk management itself is about. Risk management is always about trade-offs, trade-offs between our objectives and risks, trade-offs between different risks. Our goal here shouldn't be to avoid new technology or to pretend that the risks associated with it don't exist. It's really to understand them, design and control them so we can capture the benefits.
Yeah, that's so nice to be aware of how the risk has been analyzing. That's the one of the topics that all the companies should be involved in the processes of the risk management. So thank you for all the contents that you've been delivered and your experience. So in the end, I would like you to give a message for the listeners from your two very important experiences and financial crises that might be a very good essence for the listeners understanding of the impact of the risk management. So could you give us the mini message from your perspective?
So I think that we need to be thinking always about trading off convenience and control, thinking about the long run implications of the decisions we make, as well as the short run benefits that we perceive. I think one of the hardest management and risk management contexts is one in which there are short term benefits and long term costs, especially when those short-term benefits are really concrete and the long-term costs are not. And that can range from anything like, do I eat a donut, or do I go to the gym, to do I allow the AI agent to train on, or the AI to train on my data, and have access to my contacts and my emails and my other personal data or not. There aren't obvious answers to these things. It's contextual. So what I encourage people to do in terms of both their personal risk management and risk management organizations is to understand and explore the risks and try to think about what the consequences are and design your actions and your choices in terms of that landscape.
Yeah, thank you for a great message, Mr. Joshua. That was very nice to see what's your experiences, what you're teaching us. Like it's a very everything has been a very important for the not just only for the financial industry, but all the industry who wants to use the new advanced technology. So again, I'm very appreciated to have a discussion like this and happy to explore the how we can prevent of the risk and make it more effective for the innovation. Thank you for joining us today.
Thank you. It's been my pleasure to be here.
Thank you.